What is going on, everybody? Thank you for tuning in for today's masterclass training. Today, we're going to talk about how to become your own bank to pay off debt. This is going to be a very exciting conversation, something that I am very passionate about because so many of us struggle with debt. Debt is a thief in the night. It takes your money and you don't see it, and it sucks because it takes up most of your income, and that's what prevents a lot of us from being able to save money and invest in assets because we don't have any cash flow. So today we are going to talk about how to become your own bank so that you can pay off debt, live financially free, and start using your money to invest in assets that pay you. So I'm very excited for this. Take some notes, grab a pen and some paper, and let's just dive right into this. So, how is IBC used? IBC stands for Infinite Banking Concept. Well, here's what you can do. You can pay off your debt, you can invest in assets, you can pay for college, you can buy a car with your Infinite Banking Concept system, and you can buy a boat. Obviously, we want to be good stewards and do this strategically. We don't want to be reckless and frivolous with our money. Okay? That's very important. So, obviously, for today, we're going to focus on debt, but I am going to give you an example in regards to how you can use this for buying assets. So, what is infinite banking? So, this is a permanent life insurance policy. It is a cash value whole life, which is guaranteed to earn interest. And so what you can do is you can borrow against it as a personal line of credit. So rather than saving up money and spending cash in the banks, you overfund your whole life policy, you borrow against it, and guess what? You get to maintain uninterrupted compound interest. That is the secret to this. So why should you even consider infinite banking? Well, for one, you get to pay off debt. You can borrow against your policy to pay off debt and get out of debt much faster than you would the traditional way. You can invest in assets. You can borrow against your policy again to invest your money. So your money is not only earning interest in your policy, but it's also getting put to work, and it's a win-win situation. Your money is having babies. And the other thing you can do is you can buy a car. You can buy a car with your policy instead of buying and taking out a loan from the bank. Again, you're just going to borrow against your policy to buy a car. And then the other thing you can do, another tool, and how you can use your policy is to fund college for your kids. You can start a policy for your child as early as 9 days old, and you can let it build up cash value for 18 plus years. Just imagine that uninterrupted interest that goes for 18 years. Can you imagine how much money you would have in your policy? That would not only fund your college, the college tuition for your child, it could be money that they use for business or travel endeavors, whatever it is that your child wants to do, that money is there for them. I just want to actually talk about that for a second. Let's go back to the college fund. Just imagine if you started a policy for your child or children to pay for college. Think about how that would take the financial burden off of your shoulders. Your child wouldn't have to go into debt, and you would not have to take out any parent loans. This would save you both thousands upon thousands of dollars. That is amazing, right? Another thing you should consider. So, like I said, we have uninterrupted compound interest. So, even when you borrow against your policy, it's still earning interest as if you never took that money out. You have guaranteed loan provision. So, if you need capital, you can instantly borrow against your policy within 30 days and loan yourself some money to buy what you need or what you want. But you want to do this strategically. You want to be a good steward of your money. You have guaranteed growth plus dividends. So, your money is in the cash value whole life policy is going to earn dividends and interest. So your money is earning money. So when if you're doing a monthly deposit into your whole life policy, It's earning money. Even though you're making the deposits into this, it's going to earn money. It's tax free. So your money is going to earn interest and dividends, and that money is tax free. So if you take out money for a loan, it's tax free. If you are going to invest for a property, it's tax free. So isn't that amazing when you think about that? Because the biggest expense that you are paying, that we are all paying, are taxes. And that's what's amazing about this. This is tax free. So let me give you an example on how this works. So let's say you have a savings account. You're putting money into the savings account every single month. And what you can do here from your savings account, instead of putting your money into a savings account, you're going to put it into a cash value policy. Okay, it's just one extra step. You're putting it into a cash value whole life policy. After you start your policy, what you can do is take out a loan. After you take out that loan, you're going to pay off your debt, and then you're going to recapture that loan that you took out. It's really that simple. Okay? So, let's say for example, you're putting in $250 a month into your savings, $500 or $700. You're putting that money into your savings account. Instead of doing that, you're going to put it into your cash value whole life policy. But let's say that you have $5,000 or $10,000, $15,000, $20,000, $25,000 in your savings account. You can fully fund your policy. And when you do that, you have immediate cash value that you can use within 30 days. Now, unfortunately, if you were to do monthly deposits like 250, 500, or 700, you might want to wait about 6 months before you can actually start using the cash value, because it's going to take time. You didn't fully fund it. The goal is to fully fund your cash value whole life policy. So let me give you some juicy examples of what this looks like. So you go from your savings to starting a whole life policy. You're going to take out a loan of $2,000. Let's say that you have that available. Now, let me give you a disclaimer here. The amount of money you have available in your cash value, or the money that you can borrow against, yes, and your cash value that you have available to you, is going to be determined based on how you fund your policy. It's going to be different for everybody because everybody's in a different financial situation. So that is very important to factor in. So for this example, let's say you have $2,000 available. You're going to pay down a debt that is $2,000. So let's say you have a credit card that is $2,000 or $1,800. You're going to be able to pay it off completely. Can you imagine that, being able to pay off your credit card completely with your own bank? How amazing would that be? Not only are you going to be able to pay it off, you're never going to have to worry about that debt anymore, as long as you're responsible and not racking up more credit card debt. Your credit score is going to go up. Can you imagine how amazing that would be? Okay, after you pay down a debt, you're going to recapture it. Recapture means you're going to pay the money back with interest. But let me give you an example. After you pay down your debt, you're going to pay that money back into your policy with interest. In this example, you are going to charge yourself 7% interest. Now, you might be thinking, why am I going to charge myself 7% interest? Why do I need to charge any interest? Well, guess what? You're paying interest to the banks right now. Why are you going to pay interest to the bank and not to yourself? When you pay interest on a loan that you took out, you're earning more money. In this example, we are taking out 7%. We're paying 7% interest. Now, that's not anywhere near what the banks are charging you. This is insanely way cheaper than what the banks are charging. Or perhaps it's way lower in interest. So 2,000 times 7% is $140 over the course of 12 months. You're going to take that $2,140 divided by 12. You are going to get $178.33 a month that's going back into your policy. You're going to pay it back, and you're going to have an additional $140. So let's say 12 months later, you paid it back. What do? You're going to redo the process all over again. You're going to take out another loan, pay down your debt, and pay it back. So let's say that you are out of debt and you paid it all off. You recaptured all of your money. What's next? But before I get into that, I want to share something with you. I'm going to go back a slide just to give you the visual. So let's say that you have not only paid off your debt, you're earning more money. You have more cash, more savings. What do you do with that extra money? Well, if you started a policy, let's say with 5,000 or you're paying $250 a month, you cannot add more money. Let's say you have 5,000 in savings or 10,000. You cannot put that money into your policy. You have to start another policy. And that's where it gets really, really amazing is that you start another bank. You start another bank. Just like if you were to drive down the road, you see Wells Fargo on one corner, and then you go down a couple miles, you see another bank. It's the same thing. Same concept, right? You're just going to start another bank when you have more cash. Okay? That's the beauty of it. Because every time you start a policy, it's going to be more money, which means more cash value available to you. Okay, so like I said, after you pay off debt, what's next? Now, instead of paying off debt, you're going to take out a loan. Let's say you have $6,000 available. You can buy a mobile home. Now you might be thinking, why would I buy a mobile home? Guess what? They are actually pretty cheap. I have somebody that I know that does mobile home investing. He buys them for less than $10,000 and flips them for, 40, 50, $60,000. Or he might um, finance it, and the the homeowner is paying the mortgage on that mobile home, and he's getting that monthly cash flow. Let me give you a beautiful scenario. This is amazing, right? So 6,000 times 7% is $420 over the course of 12 months. You're going to take that $6,420 divided by 12, that's $535. Okay? Let's say you finance this mobile home and somebody's living in it and they're paying $800 a month. I wish I would have put this down in numbers on the screen, but I didn't even think about that until now. But let's say they're paying $800 a month. Okay. And just for the sake of the numbers, just to make it easier, let's say that your monthly payment is 500 and the mortgage, the payment is 800, or the mortgage is 500 and you're receiving, I'm sorry, let me back up. The monthly payment for this, for example, let's say the recapture is 500, just for easy numbers. The mortgage, the monthly payment is 800. See, what happens is that that monthly payment that they are making can go immediately to the recapture and pay back the loan that you borrowed. And guess what? You have an additional $300. Okay, can you imagine that having a monthly passive income with an extra 300? Okay, so listen, like I said, when you have extra money, you start another policy. So let's say over the course of 12 months, you're making the payments back into this policy to recapture. That extra $300 will go into savings. And then over the course of 12 months, you are now going to have more money to start a second policy. Do you see how beautiful that is? When you're able to finance and you're able to have people pay the mortgage, or let's say you buy a storage facility and people are making monthly payments, you are able to use the cash flow to pay the policy back. And then the extra money that you have can go into a savings account and then allow you to start a second policy after you recapture this, right? Isn't that amazing? Do you see how simple and amazing that is? This is what happens when you start your own bank. This is what happens when you're able to pay off debt and then eventually start investing in real estate, or you buy a storage facility and you have that monthly cash flow. Not only is somebody else going to be able to pay back the loan that you borrowed from your bank, you're going to have extra money to save for your second, third, fourth, or fifth policy. This is beautiful. This is gold. I hope that my explanation made sense to you. So, you can rinse and repeat this process. You're going to be able to get more policies every year. Is the goal is to get more policies. So why should you even consider this, right? So this is going to give you more control over your money. See, you won't have to ask ever again for a loan from the bank. Now, you can still get a credit card. I think that if you're responsible, you can get credit cards. Obviously, You want to take advantage of those points so that you can fly for free, whatever. But when you take out a loan, for example, from your policy, that's not going to affect your credit score. So you can borrow from your bank, pay it back with interest, and you are going to have more control over your money. You see, most people don't have control over the money, and they have no system that gives them control or the leverage. But when you start your own bank, you're going to have control and leverage. Now, my question for you is, would you rather pay yourself back with interest, or would you rather pay the bank or the creditor back with insane amount of interest? I think it's pretty simple. So let me just say this. If you are not good at handling money, you're struggling to manage and use your money wisely, this is not the thing for you. It takes discipline, time, and patience. So before you start your policy, get your money in order, manage your money well, and then we can talk about how to put your money to work so that you can have more control and leverage it. Because if you are not good with money and you put money into your policy and you have that cash value and you go and spend it frivolously, that is not good. You don't want to use that $2,000 or $6,000 in a horrible way. You don't want to do that. You want to use it wisely. So that wraps up today's training video. I hope this made sense to you. And I had a lot of fun talking about this because I'm very passionate about this. I want to help you become your own bank to pay off debt and eventually invest in assets. If that's something you are interested in, or maybe you just want to learn more about this, text me 951-490-3014, or you can message me on social media, Facebook, Instagram, whatever. You can message me and I will send you an application. The application is just a couple of questions that will take less than 2 minutes to fill out. That way I have a better understanding of where you are financially and how I can better serve you. So I am your Kingdom Wealth Multiplier. If you enjoyed this training, like this video, comment down below what really stood out to you. And if you are interested, reach out to me. Thank you so much.